financial news. Now, the central bankers, they are making it very, very clear that they're not going to keep this economy going forever, because there are many different reports coming out, especially from the IMF, where they're discussing how the economy looks good now, but that is going to change. And we'll discuss that in just a minute. But let's get into what is happening here in the retail market. Now, we had a report that came out last week, and they're saying that bankruptcies in the retail sector, they're at a record high during the first quarter of 2018. And this report, which is done by Moody's, confirms that, yes, bankruptcies in the retail sectors were at a record high during the first quarter of 2018. There were 9 defaults in the sector, including Sears and Claire's, during the 3 months ending in March 31st. Tops Friendly Market supermarket chain and the Bon Ton department store chain also filed for bankruptcy during this period. Defaults on corporate debt from the retail sector in the past 3 months made up almost 1/3 of defaults by corporations in all industries. And what we're seeing right now is that things are getting actually worse as time goes on. Now, again, Tops Friendly Markets, that's a supermarket chain. And many people don't buy their food over the internet. And what we're seeing right now is that traffic is drying up at the malls. Traffic at stores, they are drying up. And a lot of people are saying, you know what, I just don't have the funds to go out and to purchase like I used to. Now, there was a time, and we need to remember how this all works. There was a time in the beginning of this fiat system back in 1970s where everything was just beginning. There was really no credit. Most of the people back then only had maybe gas cards. They really didn't have the credit cards that we see today. One of the first was like Master Charge. It wasn't even called Master Card. A lot of people had Diners Club. And what has happened over the period of time, as credit, as the printing of money continued, and the devaluation of the dollar, you had to move into a credit cycle. And this is what we've been in for a very long time, where credit basically took over from people having the actual cash to go out and spend. Now, at the end of the system, what happens? Well, people are up to their eyeballs in debt. Now, think about it. Go back to the 80s, because in the 70s, we're coming off the gold standard, moving on to the petrodollar system, where there was a lot of inflation, a lot of dollars being printed. The value of the dollar was decreasing. So we saw salaries move up because of inflation. We saw housing move up. And in the 80s, all of a sudden, at that point, they were able to reduce the interest rates. Once that happened, they introduced credit cards. They introduced a lot of different things. And people were going out spending like crazy because they were spending money they really didn't have. And that was like the 80s, where you had this credit boom cycle. And that was moving into the 90s also. And then we had the housing boom, where more and more people were able to purchase the houses, and everything was growing. This is how the fiat system works. So we had the beginning stage, where it was kind of tough, middle stage, which was pretty darn good for a lot of people, and now we're at the end stage, where the system completely falls apart. People continually charged as much as they possibly can because the salaries, the wages are declining. And what happens is it hits retail, it hits the housing market, it hits food, restaurants, and during the 80s, the 90s, the early 2000s, we kept on building. Let's open more stores. Let's keep going. Let's, have the internet sales. Let's just keep building as much as we possibly can. Yes, that was the build-out phase. Now we're in the contraction phase, where a lot of people can't go out and purchase like they used to. They don't have the funds. They don't have the jobs. They're not making the salary. That's where we are today. We're at the end of the cycle. Now, back to the IMF report. They're saying that things are good right now. Well, really, are they? A lot of the countries, they have a huge amount of austerity on the people. Unemployment is continually ticking up. Yes, they manipulate the calculations to make it look good, but if you remove all those manipulated calculations, what you really see is unemployment is very, very high. And here in this country, they're saying the unemployment is anywhere from 20 to 22%, 23%. And a lot of people who've lost their positions, they've got part-time jobs. And you have to remember, what they did was you lost a full-time job, got 2 part-time jobs. It was one full-time job lost, 2 full-times gained, even though you're working part-time. And the IMF came out with their financial stability report. They're saying that The numbers look good. The global economic growth is continually growing. And they said out in the future, not too far off in the distance, because of Trump's policies of trade wars, tariffs, reciprocal taxes, slashing taxes, they see problems. Now, this widening income inequality, the IMF says that this has been exacerbated by technological advancements, and it could lead to a myriad of problems down the road. So you really think this is because of technological advancements, or do you think that there's an income inequality because basically those insiders, those central bankers, those on Wall Street, they all have the inside track, and the rest of the people are sitting here going, what is going on here? This is why the middle class is disappearing. This is why the poor are getting poorer. This is why the 1% is getting wealthier. And they're saying because of the slashing of taxes, because of the trade wars, because of the tariffs, we can see that we're going to have a huge amount of problems in the future. And this is all being blamed on what Trump has done up to this point, where he slashed taxes, there's trade wars, and they're saying as time goes on, as we reach 2020, they're projecting out, they're going to see that things are going to get worse and worse as time goes on. Now, what they're trying to tell us is that everything that Trump is doing is completely wrong. What they were doing, with Greece and Cyprus and Italy and France and, pushing austerity on the people, making the governments cut and slash and remove all the jobs and have the people suffer on the street so their debt can be paid, that is a better solution. Remember, central banks, they like to keep countries in limbo. They can't get out of their debt problem, but the debt problem doesn't sink them. And this is what they've been doing forever. The reason why they're coming down on Trump's plan so hard is because whenever there's a plan that counters the central banks and actually makes the country do much, much better than it really should be doing under the central bank, they don't like this. And I do believe that Trump will be pushing to get rid of the central bank. I mentioned this many times before, where there's Andrew Jackson hanging on his wall, and Andrew Jackson got rid of the central bank. Actually, he campaigned on getting rid of the central bank. And I think eventually, once everything's all said and done, and if the plan goes as planned, the last step would be getting rid of the central bank, because again, the central bank is the cause of these problems around the world. I'm not saying every single problem, but putting nations into debt, starting wars, and everything else all goes back to the central bank. And there's no reason we need a private corporation loaning governments currency with interest attached, where the people then have to pay taxes. You have to give up your hard-earned money and give it to the central bank, because that's really where it's going. It's not going to help the government. You're paying the interest on the debt, because the government continually needs to borrow, because there's no system put into place to say, hey, you can't borrow anymore. Yeah, the debt ceiling is a waste of time. I mean, look what they have to do. Oh, yeah, we'll just vote to raise it a little bit more. Oh, well, they've been doing this forever. The checks, the system that should be put into place to saying, okay, we can't borrow from anyone because there's no one to borrow from. This is what we have. So guess what? We can't do that program. We can't do this program. It's almost like your household. You're bringing in a certain amount of money. You know how much money you have. And guess what? You can't do these certain things. Now, if you're given a credit card, well, all of a sudden you can do a lot more, but there's interest attached. And your salary is going to go to pay off that interest on that credit card. And as you keep borrowing, you get deeper and deeper into debt. And as time goes on, the situation gets out of hand. Well, this is what's been happening in this country for a very long time. This is why we're in the trillions in debt. Not a million, not a billion, but trillions. 20 trillion. Actually, it's a lot higher than that, because if you count the unfunded liabilities and everything else, it's much, much, much higher than that. And this is because the government officials who have special interest groups, they don't really care. I mean, look, they put together a spending bill of over $1 trillion. I mean, where is this coming from? Yeah, they're going to borrow it. And then they're going to say, oh, we don't have enough tax receipts coming in to pay for the interest on this. So we have to keep the interest very low. If the interest moves up, guess what? It's game over. This is why you're not seeing it happen. And if they do continually raise the interest rates, which they're doing very slowly, guess what happens to the entire system? It crashes. This system is not designed to be a benefit to the people. This system is designed to benefit the central bank in every single way. Because no matter what happens, guess what? Their debt obligation doesn't go away. The people still owe the central bank, unless, of course, the president or someone says, you know what, we're just getting rid of this. We're going to pay off the original note to the central bank, and we're getting rid of it, and all this debt is made up anyhow. We don't have to pay it. But at this point, with the government officials, they're intertwined with the central bank. And I think what Trump is going to do eventually, because he realizes what is happening here, he's a businessman, and there's patriots behind him looking at this saying, yeah, we need to get rid of the central bank. Andrew Jackson saw this and said, yeah, we don't need this type of system. The founding fathers warned us of this. And of course, in 1913, well, that's when the central bank was once again brought into the United States under the Federal Reserve name, which made it seem like it was part of the government, and it was all a ruse to enslave the people. That's really, you're a slave in this system. Think about it. You're working every day, and you're giving a portion of your hard-earned work, your currency that you're receiving, off to a central bank. You're paying the government, and then the government has to pay back the central bank because there's interest attached. So you're working for the central bank. This is why it's called a Federal Reserve note. That's why it's not a U.S. Treasury bill. It's a Federal Reserve note. It's an instrument of debt. So what we're seeing right now is that the IMF is worried. The Fed is worried because what he's doing right now is he's pushing to destroy the central bank economy, not the people's economy. This is the central bank's economy. And don't get confused. When I say destroy, I don't mean just bring it down and restart it. I mean get rid of it. The central bank, well, they like to bring the economy down because they make money when the economy's up. When it's down, it doesn't really make a difference. They want to bring it down so they can restart it again. And the central bank, the way they do it is they make it seem like they're not really doing anything to affect the economy. They're bringing the interest rates up very, very slowly. Everything looks great. And they know what happens each time they bring the interest rates up. The economy starts to buckle under the weight. Things start to go south, and then they start bringing the interest rates down again. But it's a chain reaction, and they know this. And by the time the economy comes down, they've been bringing the interest rates down, and they can say, we had nothing to do with this. It wasn't our fault. But there might be something else that brings it down because there's so many black swans out there. The LIBOR rate is continually increasing every single month or so. And since the beginning until now, since they brought the rates down, it has increased. And what's very interesting about this is that the U.S. Fed funds rate, the LIBOR rates, that first of all, it stands for the London Interbank Offered Rate, which is an important benchmark interest rate that is used for price loans across the globe. When the LIBOR rate is low, it means that loans are inexpensive, and vice versa. And with the U.S. Fed funds rate, the LIBOR rates were cut to record low levels during the 2008-2009 financial crisis in order to encourage more borrowing and, economic growth and things like that. Unfortunately, economic booms that are created via the central bank manipulation of borrowing costs are typically temporary bubble booms rather than sustainable organic economic booms. When central banks raise borrowing costs as an economic cycle matures, the growth driving bubbles pop, leading to a bear market, financial crisis, and recession. When you look at the LIBOR rate and you look at the chart, you can see the historic bubbles where they are formed during those low LIBOR rates. And as the rate moves up, guess what happens? All of a sudden, the bubble pops. And we saw this, and the chart matches up to the 2007-2008 crisis. We see it going back to the dot-com bubble in 2001. We see it going back to the 1992-1991 crisis there. I mean, each time it correlates with what has happened with LIBOR. So we're seeing a lot of these indicators letting us know that problems are headed our way. Now, what's very interesting is that there are many countries now dumping treasuries. China decided not to purchase anymore. They were dumping. We see Japan, they are dumping their treasuries. And Russia, the Central Bank of Russia, has sold $3.1 billion in U.S. Treasury bills as of February, reducing its investment in American debt to the lowest level since March of last year, and they're expecting to dump even more. Now, the question is, was this part of the plan? Because we can see that Trump is working with China on the trade deals and building and creating everything for the new economy. In the meantime, countries are dumping treasuries. He's already explaining to the country and to the world that Russia and China, they are basically devaluing their currency, and it looks like they might be pushing a currency war where he's going to devalue the dollar and maybe have the dollar crash, because we know that the central banks, they have to raise interest rates during this period of time. And we know what happens when they raise interest rates. Well, they keep raising it until the economy buckles under the weight, and then they start lowering it, but it's too late. We mentioned that before, and the economy comes down. So what do we see here? We see the LIBOR rate moving up, and we've seen the pattern there where every time it is brought to the lowest point and starts moving up like this, the economies come down. When the Fed raises their rates during a low interest rate type of period of time, they bring the economy down. And it looks like Trump is pushing the agenda to do the same thing and to force the central bank into doing this. Now, he needs to control the narrative of when this system comes down, and he can point the finger at the central bank saying, listen, we have proof. We know they raised the rates. The LIBOR rate was going up. People were dumping the treasuries. The interest rates were moving up, and that brought down the economy. Stock market came down. Jobs are being lost. Maybe we should look into the Fed's affairs. Maybe we should audit the Fed. And he can start this type of investigation into what the Fed has done, if he can build the case. Just like the case against Facebook, which Q did mention that this was going to come out, and it did come out. Just like when Trump mentioned Obama was spying on him. And all of a sudden, now we have this FISA investigation going on. All he has to do is the same exact thing with the central bank. Mention it, saying, I think something's going on with the central bank. I think they caused this by raising interest rates, by manipulating. And all of a sudden, Congress and those people that have been pushing an audit the Fed bill might say, hey, let's push this again. And it might go through. You know, he's going to sign it. And this might be the start of auditing the Fed. It's that simple. Once you get everything into place, all you have to do is mention it a couple of times. People get wind of it, and especially if the economy's crashing, guess what? You can definitely make the case.